Hello everyone, welcome to FISC Financial Studies classes. This is CFA level 1 reading number 48, LOS 4 and 5. This is the last LOS of this reading, and here we are going to discuss about what is the purpose of derivative market, what are the controversies related to it, and also we will look at what is arbitrage and how it is going to help in improving promoting the price efficiency in the market. So first, what is the purpose of derivative markets? The first purpose is risk allocation, transfer and management. If you have seen the last videos, that there is basically a risk management, which is the basic purpose of the futures, options or swaps, where we fix the price of the future so that we don't have any downside risk. Second purpose is operational advantage. Futures are bought at some margin. The swaps has no initial payment and the options has a premium to pay, whereas if you really want to do the operations by selling or buying the stocks or any underlying asset, you just have to pay the full price, and that's why it is operationally efficient and advantageous to deal in derivatives in most of the cases. If you are not able to understand it right now, there is no issue in that, because this is a topic which we cover later in level 1 and then in level 2 and level 3, so it is a very broad reading. You just have to understand that it is advantageous operationally to deal on derivatives as compared to underlying assets. The third purpose is price discovery. We haven't touched upon the price and valuation of derivatives, but this is a very important area. Pricing and valuation of derivatives not only help us in understanding the price of derivatives, but it also determines the price of the stock. There are very well-known formulas like Black-Scholes models, and there are binomial models. There are put-call parity. All these terms may seem here alien to you this time, but in the future, when you read about it, you will be able to understand it very well. Last purpose is market efficiency. So, as we all know that the stock trade at different price in different exchanges, and there could be some inefficiency in the market. Derivatives try to make that market more efficient by providing you better deals at a lower cost, and that's why it helps in market efficiency. Derivatives and derivative market also has some criticisms and misuses. The first one is speculation and gambling. If you really go and look at the stock market or derivatives market, you would find that most of the people are trader or speculators. In a stock market, the number of intraday trader is much more than the proper value investors, and similarly in the derivatives market, the speculators are doing a lot of trade as compared to people who really want to hedge their risk, and that's the downside of derivative market. But it is promoted by the government, it is promoted by the agencies, because they are earning brokerages, taxes, and that's why they like this speculation, they like this intraday trading. The other issue with derivative market is that due to this excessive trading, they are causing a kind of destabilization in the market, which creates a systemic risk in the market. Now we'll learn about what is arbitrage, kind of method where you are going to earn profit without taking any risk. This is a profit where you are not investing anything, but still you are making money. So what happens is that there is a law of one price which says that an identical object has same price in every market. So when you see that there are multiple stock exchanges across the world, and at least in every country there are more than one stock exchanges. So in those places, if you look at the stock markets, different stock market may have different prices for the same stock, and that's where a person could take advantage through arbitrage. So suppose there is a market 1 in this example where stock X is trading at 50, whereas in market 2 it is trading at 52. So what a person can do is he buy the stock X at 50 from market 1 and go and sell it in market 2 at 52 and earn a profit of 2 without investing a penny. That's called arbitrage. So what happens now is that the people starts buying at 50 and selling at 52. So the 50, the market one has, so the stock X price in market 1 starts increasing, whereas the stock price in market 2 starts decreasing, and they reach a level where both prices are equal. So suppose 50 increases up to 51, whereas 52 decreases up to 51, so the price of the stock become 51 at all the markets. That's the way the arbitrage work in improving price efficiency. So the last one was an example where you didn't invested any money or keep it for a certain period. It was an instantaneous action. But now we are going to invest the money for a period, maybe 1 year. So this is an example of CFA curriculum where there are two stocks, AXE and BYF. AXE is $50, BYF $38. In the period to the next period, the AXE would increase to 75 and BYF would increase to 60 if the market is going up. If the market goes down, AXE will reduce to 40 and BYF reduce to 32. The risk-free rate in this market is 4%. Now, how we are going to use arbitrage here is explained in next exhibit. So you can see here that they are saying to short sell XC at 100 shares of XC, and that means that we are going to get $5,000 by this short sale. We will invest $4,750 in buying BYF 125 shares, and we will invest the rest 250 in the bonds. So the net investment is zero because we short sell one stock, and from that earning we are investing it in the other stock and bond. Now in the next period, if the price goes up, the BYF increase to 60. When we sell it, we will get $7,500. If we look at the position of AXE, to cover that position, cover that short position, we have to pay 7,500, 75 into 100, which we have already earned from the sale of BYF. So the position is covered and we still have a bond of $250 investment, and that increased up to $260. So the net profit in this case is $260 without investing a money. Now in the next case, when market goes down, again when we sell the BYF share, we get $4,000, which is equivalent to the position, to the amount required to cover the position of AXE share, and the rest amount which we gain from the bond investment is our net profit. So in both the cases we are earning $260. Now it's a really hypothetical example, but it can be applied in the real world as well. Now so this is what we had to study in the arbitrage, and from here the reading number 40 is complete. We'll see you in other sessions. Please like, subscribe and share this video lectures, and share it with as many people as you can. Please comment and let us know how you are feeling about these videos and what kind of topic you are really interested in. Thank you very much.